In October 2005, a financial titan crumbled in a matter of days, sending shockwaves through global capital markets. Refco, one of the world's premier commodities and futures brokers, had successfully completed a massive initial public offering just 2 weeks earlier, raising over $500 million. Yet beneath the veneer of staggering profitability lay a $250 million deception that shattered investor confidence and led to one of the most rapid corporate collapses in American history. At the center of this financial catastrophe was Philip Bennett, Refco's long-serving chief executive officer. Bennett had built the brokerage into a Wall Street power, commanding absolute authority over its internal operations and financial reporting. His dominant presence created an environment where operational procedures went unchallenged, allowing critical accounting decisions to remain concentrated within a tight circle of executive leadership. The genesis of the fraud stemmed from catastrophic customer trading losses incurred during market crises in the late 1990s, including the 1997 Asian financial meltdown. Rather than absorbing these bad debts on Refco's balance sheet, which would have severely impaired the firm's net capital requirements and scared away potential investors, Bennett chose to conceal them. He devised an intricate scheme to remove hundreds of millions of dollars in uncollectible customer debt from public view. To execute this deception, Bennett utilized an off-balance sheet debt transfer strategy. Off-balance sheet debt refers to obligations or losses that an entity holds through separate, non-consolidated entities, effectively hiding financial liabilities from public balance sheets. Bennett created an unconsolidated shell company named RG Global, an entity technically independent of Refco on paper, but secretly controlled by Bennett himself. He systematically transferred Refco's bad customer receivables to RG Global's books, replacing toxic debts with seemingly valid receivables. Maintaining this illusion required sophisticated quarterly maneuvering designed to fool outside auditors and financial analysts. Days before the end of each fiscal quarter, Bennett organized circular loan transactions. RG Global would borrow tens of millions of dollars from an independent financial institution, then use those funds to pay down its debt to Refco. Once the quarter ended and auditors completed their snapshot of the firm's balance sheet, the transaction was promptly reversed, returning the toxic debt to RG Global. This deceptive cycle relied on third-party market participants who remained entirely unaware of their role in the accounting shell game. Financial firms like Liberty Corner Capital were engaged to facilitate these short-term, low-risk loans, believing they were routine liquidity transactions. In reality, these arrangements served solely to wipe Refco's books clean for crucial accounting dates, ensuring that regulatory capital compliance appeared flawless while masking hundreds of millions in accumulated non-performing debt. The broader historical context made this accounting failure particularly alarming to financial regulators. The early 2000s had seen the enactment of the Sarbanes-Oxley Act, federal legislation specifically designed to mandate strict corporate governance, internal auditing controls, and executive accountability following major corporate crashes like Enron. Refco's ability to maintain a hidden $250 million ledger for over 7 years exposed severe structural flaws in standard corporate compliance frameworks. As Refco prepared for its high-stakes initial public offering in August 2005, the pressure to maintain immaculate financial statements reached an all-time high. Investment bankers, prospective shareholders, and regulatory authorities closely scrutinized the company's financial records. Yet, despite extensive due diligence conducted by elite Wall Street underwriting syndicates, the deceptive quarterly loan rotations went completely undetected, clearing the path for Refco's celebrated market debut. The unraveling began only 2 months after the public offering, driven not by regulatory agency enforcement, but by internal financial scrutiny. As Refco prepared its quarterly filing for the Securities and Exchange Commission, a diligent internal auditor began examining specific balance sheet line items. The auditor discovered an unexplained receivable amounting to $430 million owed to Refco by an outside customer entity, sparking deeper forensic questions. Investigating further, the internal audit staff identified anomalous interest payment entries connected to this massive debt. Refco was routinely paying interest to an external counterparty for holding obligations that should have been classified as direct losses on Refco's own books. The economic logic of the arrangement collapsed under forensic inspection, revealing that the foreign counterparty was merely a conduit for Philip Bennett's personal shell company. Faced with undeniable accounting anomalies, Refco's internal team presented their findings to the board of directors during an emergency weekend session in early October 2005. Confronted by board members and external legal advisors, Bennett was unable to produce valid business justifications for the off-balance sheet arrangements. The elaborate balance sheet illusion had finally shattered, leaving executive management no choice but to take drastic public action. On Sunday evening, October 9, 2005, Refco issued a stunning press statement announcing that it had placed Philip Bennett on administrative leave. The company disclosed that it had discovered $430 million in undisclosed debts owed by an entity controlled by its chief executive officer. Refco warned investors that its audited financial statements for the previous 3 fiscal years could no longer be relied upon by the market. The market response was swift and devastating. Within 48 hours, Refco's stock price plummeted by more than 70% as institutional investors rushed to liquidate their positions. Futures traders and institutional clients, terrified that their collateral deposits might be trapped in a failing institution, initiated a massive run on the brokerage, demanding the immediate withdrawal of billions of dollars in trading capital. Federal authorities moved with extraordinary speed as the systemic threat became clear. Within 3 days of the public disclosure, federal prosecutors and criminal investigators arrested Philip Bennett at his Manhattan residence, charging him with securities fraud and wire fraud. The rapid intervention signaled the government's determination to contain market panic, but the operational damage to Refco was already irreversible. The failure cast a harsh light on systemic vulnerabilities within investment banking due diligence. Financial analysts questioned how sophisticated underwriters and major independent auditing firms could have missed repetitive multi-hundred-million-dollar transactions occurring precisely at the end of every fiscal quarter. The scandal demonstrated that traditional audit methodologies often failed to detect collusion and off-balance sheet manipulations executed by top executives. Deprived of customer trust and liquidity, Refco was forced to freeze trading operations to prevent complete cash depletion. Just 17 days after celebrating its triumph on the New York Stock Exchange, Refco filed for Chapter 11 bankruptcy protection. The collapse stands as one of the fastest declines of a newly public financial enterprise in corporate history, wiping out billions of dollars in shareholder value overnight. The corporate autopsy of Refco yielded vital lessons for modern regulatory compliance and corporate auditing procedures. Regulatory bodies subsequently tightened disclosure requirements for related party transactions, ensuring that any financial relationship involving executive officers faces rigorous, independent oversight. The case demonstrated that off-balance sheet arrangements require continuous, substantive analysis rather than passive reliance on quarterly snapshot reporting. The psychological dynamics of the executive office also played a critical role in facilitating the long-running deception. Bennett's centralized authority created an atmosphere where lower-level employees hesitated to question irregular transactions or complex accounting structures. Organizational structures that lack clear, protected whistleblowing channels routinely create blind spots where fraudulent executive behavior can flourish unchecked for years. In today's complex financial landscape, where high-frequency trading and algorithmic execution move billions across international borders in milliseconds, the risk of hidden ledger manipulation remains a critical threat. Modern accounting fraud rarely involves physical theft. Instead, it relies on sophisticated structural misdirection, digital ledger obfuscation, and subtle exploitations of accounting standards that require constant vigilance to detect. Protecting systemic market integrity requires robust forensic auditing techniques capable of tracking real-time capital flows across complex web entities. Investors and compliance professionals must look beyond surface-level balance sheet profitability, examining the fundamental economic substance of related party transactions and short-term debt maneuvers that occur near reporting deadlines. The legacy of the Refco scandal remains a powerful cautionary tale about the perils of corporate opacity and unrestrained executive power. Philip Bennett was eventually convicted and sentenced to 16 years in federal prison for his role in orchestrating the massive accounting fraud. Ultimately, the fall of Refco proves that no matter how vast a financial institution may appear, a foundation built on deceptive accounting will inevitably collapse under the weight of truth. New Stories Weekly. Stay one step ahead of the fraud. Subscribe.